if you don't know where to begin, better ask Win.
Shane, good to see you. Happy Rothtober. Today we are talking through 3 considerations before making a Roth conversion. Roth accounts are an amazing tool when it comes to creating wealth. Roth IRAs are not subject to probate and can pass on to your heirs tax-free. So if you are considering a Roth conversion, you need to ask yourself a few questions. First one is, what will your future tax rate be?
This is a tough thing to probably figure out, right? But the old story was, hey, when you get into retirement, your tax bracket should be lower because you have less earned income. But people are finding out that that's not always the case. But in most cases, you can assume you'll drop at least a little bit, hopefully, which could create some room for some Roth conversions in retirement.
Right, but we can only assume, Shane, right, that the tax rates are going to go up starting in 2026.
Exactly. We know the Tax Cuts and Jobs Act is going to expire at the end of 2025. And like the chart shows here, we could see rates nearly double in terms of the brackets, like the 12%, for example, married filing jointly becomes $23,200 as the max, as opposed to about $11,000 now.
Yikes. Next question, when will you need access to those funds?
This is a big thing to pay attention to with Roths, and most people don't know that this 5-year rule exists. So if you start a Roth right now, that starts a 5-year clock ticking, and you have to wait through that 5-year period before you can take all the money back out of the account if you wanted to and enjoy the tax-free benefits of it. So I always tell people, if you're even considering a Roth, just start one right now, put $100 in it, because that will start your 5-year clock.
Yeah, good advice. And then last, when considering a conversion, it comes down to one important question. Do you want to pay the tax on this account, or do you want your beneficiary to pay the tax? And then you need to consider, what will your beneficiary's future tax rate be?
Exactly. So when the Secure Act was passed, they instituted the 10-year rule and eliminated the stretch IRA, which basically means if you leave money to a beneficiary, non-spousal beneficiary, that person now has 10 years to distribute that entire amount of money. So if you have a son, a daughter who's earning a high income, they're a professional, and you leave them $1 million IRA, for example, they now have to add $100,000 a year effectively to their own income, push them into an even higher tax bracket, right? It just gets very inefficient. Perhaps it makes more sense for you as the retiree to pay the tax on those IRAs and move them on to the next generation in a tax-free manner. Is really quite a bit more efficient, especially in 24 and 25, while we still live under the Tax Cuts and Jobs Act of 2017.
I'm glad you brought that up, and it bears repeating. We are living in a historically low tax rate right now, and many financial experts believe the Tax Cuts and Jobs Act of 2017 reduced federal income tax rates to the lowest they may ever be, and those cuts are set to expire at the end of 2025.
That's exactly right. So again, you have 24 and 25 to make conversions in this low tax environment. And January 1st, 2026, things go back to what they were in 2017, which does equate to real increases in the federal income tax brackets.
No fun. All right. Well, Shane, like I said, Rothtober right now, we have until the calendar year to make those conversions. So if somebody would like to crunch the numbers with you, how can they reach you?
Best way to reach us is online or by phone. Our website is winstonandcompanies.com, or give us a call here at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.